Hello, everyone. Thank you for joining us today for our financial webcast titled Last Chance to Reduce 2023 Income Taxes. My name is Dan, the moderator for the webcast. Today's webcast presenter is Jim Holtzman, CFP, CEO, President and Wealth Advisor of Legend Financial Advisors. Please hold as I turn it over to Jim.
Okay, thank you everybody for joining us today. Surprising as it may seem, income tax legislation has been relatively calm this year, and there's not, at least at this point, there aren't many major changes that are set to take place in 2024. But that doesn't mean there's not a lot of planning that still can be done on a typical annual basis, which is a lot of what we'll cover today. So jumping into this, the first screen that you'll see, it just kind of walks through what taxable income is. And the importance of taxable income is that is actually what determines your tax bracket. So just kind of going through this calculation, you're taking your gross income, you will subtract what are called above adjusted gross income deductions. Most people don't have too many of those type of write-offs. If you're self-employed, there's a couple that will apply, like self-employed health insurance, for example. If you have the ability to write off an IRA contribution, that's where that will show up here. And then from there, you subtract the greater of your itemized deductions or your standard deduction. I'll also cover some of those items more specifically later on in the webcast. And then something that's been actually gone since 2019, but I still get the question, is about personal exemptions. You're no longer able to write those off. So that went away in 2019. I've kept it on here just because until I keep getting the questions, and I know it's confusing because you still hear the term personal exemption, but there is not a formal way to write those off anymore. So once you go through these gyrations, then you're at the point of calculating your taxable income. So oftentimes when determining tax brackets, I'll get the question about your salary, for example. The number that shows up in your W-2 is really being the driver of what drives your tax bracket. And that's not the case. It's part of it, but it's not entirely the case, because you do have the ability for some deductions to take place. And there's other forms of income, interest, dividends, capital gains all play into this. So that's why I always start with this slide, is just to kind of take a step back and understand what is the number that drives your income tax bracket. So this schedule is for the tax rates themselves, and this one just specifically applies to single filers. And so the way you want to read this is I have 2022's rates right here, and then I have 2023's rate right here. Now this column, I'll just focus on 2023. This is the range of taxable income that applies to each tax bracket. So the thing you will notice maybe first is that the tax rates have not changed themselves in 2023 when compared to 2022. What does change a little bit, and this happens each year, is the brackets update. So you'll see for 2023, the range is from $0 to $11,000, where last year that range was $0 to $10,275. So every year, these brackets get inflated based on inflation. And so that's why you'll see these numbers change as you kind of look for where things were in 22 versus where they are in 23. So that's how you read this. So I'm not going to read every row as part of this webcast. These slides will be available to help you reference maybe where you fall into the certain ranges. And then I'm going to go to the next slide, which will look similar, except it's going to cover married filing joint. So the structure is the same, the tax rates are the same. However, what you might notice is that the taxable income ranges are different. They're basically going to be double the single filing status. So in this case, at the 10% bracket, it ranges from 0 to 22,000. That increased from 0 to 20,550 last year. So when we're going through tax planning with our clients, understanding these ranges is really important when you're trying to make decisions, because maybe you're in the 12% bracket and you're looking to make some kind of a tax planning decision, and you want to be careful that you don't bump yourself into the next bracket, because then that's a 10% bump up in the tax bracket. One other thing that I'll point out, I get this question pretty often, is that when you are in, let's say you're in the 22% bracket, the 22% doesn't apply to all income once you get into this bracket. Let's say you had 95,000 of taxable income. So it's not like all 95,000 gets applied to 22%. You go through the calculation where 10% of the 22,000, that's $2,200, that's a tax number. Then you have 12%. In my example, where your taxable income is 95,000, you would basically apply this 12% at this range, and then you'll calculate that number. Then in the 95,000 taxable income example, you would take 95,000 minus this 89,451 number, so it's a little over $5,000. That amount is applied at 22%. So it's not like once you get in this bracket, everything's at 22%. It's not the case. It's just the portion above the beginning of this range. So I know that's confusing. So oftentimes, I'll get that question thinking, oh, I'm in the 22% bracket, and that might be true for the next dollar that's going to be taxed, but that is not all of your income getting taxed at 22%. So for trusts and estates, again, the tax rates didn't change. The income ranges did, and you can see what those are. The big item of note is that you get to the top bracket really quickly of 37%, and that's when you have more than $14,450 of taxable income for trust purposes. So oftentimes you want to be careful about how you have the trust set up. If you're just accumulating the income, that can be a problem, at least for tax purposes. It might make sense, but you want to at least recognize that you're going to pay a higher tax rate in that situation versus having the income distributed out to the beneficiaries, for example. So the next topic is going to be regarding estimated tax payments, and the purpose of these are to make sure that you've paid in enough taxes throughout the year. Because what you're trying to avoid is what's called an underpayment penalty. So think of an underpayment penalty as an interest rate charge by the IRS for you holding on to your money too long throughout the year. So what the IRS is looking for, they want you to pay in the lesser of 90% of your current year tax on a quarterly basis, or you pay 100% of last year's tax, or it's 110% of last year's tax if your prior year AGI or adjusted gross income is greater than $150,000. So again, it's lesser of 90% of current tax, or basically some percentage off of your prior year tax number. If you don't have a lot of deviations from one year to the next, say current year versus prior year, oftentimes it's easier to target the prior year number because it's a fixed number. It's not going to move. Your tax is already done for the year 2022 in this example, so you can just focus on making sure you pay that same amount in every quarter. Now, if your income's fluctuating a lot and you want to pay in the 90% of current year tax, that's not a problem. It's just that's always going to be a moving number, so you have to kind of go through that calculation on a quarterly basis. Oftentimes, if you have a CPA that prepares your taxes, they'll by default target your prior year tax number unless there's a significant change that you're anticipating, just because it really helps make it easy, and it's locked in number, and it's very simple to follow. So the other thing you can do is you get towards your end, if you have not paid in enough and you have the ability to adjust your withholding, say on your paycheck, you can adjust your withholding up or down depending on what you're trying to do to avoid the underpayment penalty. The way the system works is that this calculation that I'm going through really gets run every quarter. And once you accrue, let's say you get through the first quarter of the year and you haven't paid in enough, then that penalty starts to accrue basically at that point. So the only way you can stop the penalty from accruing is to make an estimated payment basically as soon as you can, and then that kind of stops the bleeding, if you will. You'll still have a penalty, but it'll stop accruing at that point. And that's because they record your estimated payments on the date they receive them. If you use withholding, the way it works is that withholding kind of gets applied to your overall tax withholding throughout the year. So if you have an underpayment penalty, you could actually really bump up your withholding, and you could actually wipe out an underpayment penalty if you're able to withhold the right amount. So this gives you a little more flexibility in terms of trying to do that if you're behind or maybe haven't paid in enough so far on a year-to-date basis. But at the minimum, you can make an estimated payment and at least stop the interest from accruing on that penalty. So I always, when I explain this process to a client, think of it this way. Again, it's basically an interest loan that the IRS is giving, and they're charging you. I think the rate now is somewhere around maybe 8 to 9% because of interest rates having gone up. So, you make the decision, you're going to pay an interest penalty, and because you're going to hold on to the money. But if you're only able to get on money market rates, we're getting about 5.25% for our clients right now. You're still going to be behind the 8 ball because you're going to have an interest rate penalty if you don't pay in enough of maybe between 8 and 9%. So same thing applies for states. If your state has an income tax, don't forget about these. They do the same, pretty similar process. You're going to pay the lesser of 90% or 100% of the prior year tax. Most states follow that. They don't have that extra criteria based on a higher income number like the IRS does. But most states pretty much follow that system as far as the ones that have an income tax. So we're going to talk a little bit about portfolio income and how that impacts some planning that you can do still between now and year end. So you have the ability, if you have taxable accounts, not a retirement account, not an IRA or a 401k, but if you have a taxable account with investments in it, and let's say you've incurred some capital gains this year as you rebalanced your portfolio. So you have the ability to take a fresh look at your portfolio between now and year end, and maybe there are some losses. The markets have been a little down over the last couple of months. You could actually recognize a loss by selling an investment, and that can be used to offset maybe other capital gains that you've incurred so far this year. So you hear the term tax loss harvesting, and that's what we're referencing. So in these cases, you have the ability to write off all of your capital gains if you have enough losses to do so. And then you're also allowed to deduct an additional $3,000 of capital losses against ordinary income. And that's going to be like wages, interest, dividends, things like that. And then if you have, I'll try to give an example. Let's say you had so far $10,000 of capital gains for the year. And let's say you had let's go with $20,000 of capital losses that you could take. So in my example, you would take the $20,000 of capital losses, $10,000 would get applied to the capital gain number already incurred, $3,000 would able to be deducted against ordinary income, and you're left with $7,000 of capital losses. That $7,000 number is able to be carried forward to next year, meaning 2024. So you can use that to wipe out any capital gains, or at least up to that $7,000 mark. So we do for our clients every year. We do this throughout the year, but we put another emphasis on this in the fourth quarter of the calendar year, is we will go through, check on all of our client accounts that are taxable, see if there's capital gains, and then we take a look to see if we can recognize any capital losses, just do everything we can do to minimize the tax hit for the client. We have to do that all in the context of the investment decision that you're making, but we do make that effort every year for our clients to try to mitigate the capital gain taxes. The capital loss carryover, so if you're, don't forget to look, this information will show up on your prior year return. So just don't forget about that if you're self-preparing the return, or if you're working with a CPA or a new CPA, they'll always ask for the prior year return. This is one of the reasons, because that loss carryover will get recorded there, and you don't want to lose it. So for capital gains, there are short-term and long-term capital gains. So a short-term capital gain is where you hold an investment for 1 year or less. So when you do that, you're going to pay taxes at what we call your ordinary tax rate, which will follow that schedule that I shared at the very beginning of this presentation. If you hold it for long-term, which is where you hold the investment for longer than 1 year, you get more favorable tax rates. If you're in the 10 and 12% tax bracket, you actually have 0% long-term capital gains rate. So you can do a lot of planning there if that applies. If you're in the 22 to 35% bracket, you have a long-term capital gains rate of 15%. And then if you're in the top tax bracket, your long-term capital gains rate is 20%. The same thing applies for dividends that are qualified. They'll follow this schedule as well. Qualified dividends, for the most part, will be dividends paid from a US-based company. If you have non-qualified dividends, which could be dividends from a bond mutual fund, maybe a real estate investment trust, or an international-based company, those are non-qualified and those get taxed at your ordinary tax bracket. So it's just good to be aware of that. But you can do a lot of planning if you do have some investments with built-in capital gains. You want to maybe take those positions down, and you're in these lowest two brackets. You can be very strategic and maybe not have to pay any taxes on those gains. One of the things we do for our clients as we head into year end, we're maybe looking at investment decisions, maybe an investment to buy. We will check before we make that purchase to make sure that that investment is not going to pay a capital gain distribution. So for example, in a mutual fund, the mutual fund will own 100 stocks, for example, and the fund manager is buying and selling throughout the year. Well, if they have a net capital gain at the end of the year, they have to pass it on to the shareholder, and that's what a capital gain distribution is. It doesn't mean you sold that investment. This is the activity within the investment itself. So you want to be careful if you're looking to make a buy that you don't buy a fund that's going to pay a large capital gain distribution, because those gains are, if you would have had to own that fund for some period of time beforehand to have actually gotten the benefit of that. So if you bought into a fund that's going to pay a distribution, say in the next month, then you're going to be paying taxes on someone else's gains. This is another way to look at it. So it's just something to be careful with. ETFs or exchange traded funds don't often pay as much in the way of capital gain distributions like mutual funds do, but they can. These are touted as being very tax efficient, which is true most of the time, but don't assume that they can't pay a capital gain distribution. It's always worth checking into. Cost basis reporting, I'm not going to spend much time on this one, but basically there are, depending on how old an investment has been owned for, your brokerage firm might not have the cost basis information. So you want to be careful when you go to sell it that you provide that information to the brokerage firm so they have it in one respect, they can report it on the tax form. But number two, you also want to make sure you know what the cost basis is before you sell it. So this has been in place for, as you can see, quite a long time, but you might have investments that were purchased way before these time frames, maybe 20 years ago, for example. So now we're going to jump into itemized deductions. So to start with, so you write off one of those deductions that I showed on the very first screen is the greater of your standard deduction or your itemized deductions. So the first part of this, we'll talk about standard deduction. The amount differs depending on your filing status. So for married filing joint last year, everybody got a deduction of $25,900. That has increased this year to $27,700. And so that's how you read this first part, and you can see just how they differ depending on the filing status. And then down below, there is an additional standard deduction if you are older than age 65 or blind. There's another deduction for that. The tax softwares will pick up on that, provided you've entered the information correctly. But you can see those also went up a little bit from 2022 to 2023. Mortgage interest can still be written off in terms of mortgage tied to your primary residence, and it can apply actually up to 2 homes for mortgage interest. So if you do have 2 homes and you have a mortgage on both, you do have the ability to write off the mortgage interest for 2 homes. There is a limit in terms of how much mortgage you can have that you can use the interest expense from to write off for. So there are some limitations, but most people are able to at least write off that amount. Home equity interest, a number of years ago, they made some changes on this. And so basically, when you're looking at writing off interest for a home equity line of credit or a home equity loan, you basically want to be careful about what the money is used for. So if it's used for improving the residence and it's not used for like buying a car, using for the residence, you can still write off the interest expense. But if it's used for buying, say, a car, something not tied to the home, then that's what's been limited. in terms of being able to write off the home equity line of credit or home equity loan interest. Charitable contributions, they're still deductible. And maybe the one thing to recognize is that there are limitations based on your income, how much you can write off each year. But basically, a lot of those have been loosened up over the last few years for charitable contributions. But it's important to know you still have the ability to write those off, but they're all part of the total amount of itemized deductions, which has to exceed that standard deduction that I first covered. Just a couple of points of information. I always get this question inevitably a couple of times in December, is that as long as the check's mailed on December 31 for a charity, it counts as the deduction for that year. If it's a credit card charge to that charity, it counts in the year charge. So if you did that charge on December 31, you're good to go for this year. Donor advised funds, this is a type of a fund where you can try to kind of front load your charitable deductions. And what I mean by that is since they've increased the standard deductions so much and they've limited some other itemized deductions, it's really hard for taxpayers to itemize their deductions because of those limitations. So you can actually kind of bunch, say, 2 to 3 years worth of charitable deductions and gift into a donor advised fund. And what that donor advised fund allows you to do is that you can then have your gifting distributed from the donor advised fund over whatever period of time makes sense. But you'd be able to accumulate the deductions in the year of contribution. So maybe as opposed to not itemizing your deductions any year, if you bunched your charitable obligations and put them into a donor advised fund to be paid out over, say, 4 years, maybe once every 4 years you'll be able to itemize. It's just a way, depending on how much you gift typically and depending on your other itemized deductions, it could be an interesting strategy to at least take a look at. And then also with the donor advised fund, you can gift highly appreciated assets into the donor advised fund. Then the donor advised fund sells the investment. You don't pay the tax. You still get the tax write-off. And then if you bunch everything together, maybe you're ultimately able to itemize your deductions. Medical expenses, so those are still deductible. They only, you can only write off the amount that exceeds 7.5% of adjusted gross income. Miscellaneous itemized deductions, this hasn't been available for a number of years now. I still get asked the question, therefore I've left it on here. Some of those examples were tax prep fees, investment related fees, safety deposit box, that kind of stuff. This was a big one that changed a number of years ago, state and local income tax and real estate tax. So you used to be able to just write off all of that, and then that was always a big expense item that pushed taxpayers into that ability to write off and itemize. Then what happened was a handful of years ago, they put a $10,000 cap on all of this. So that includes state and local income tax, real estate tax, if you have a personal property tax, those kind of things. You can only write off up to $10,000. So those that live maybe in a high, whether income tax state or real estate tax state, you're probably paying more than that. And that always was really the big driver on allowing a taxpayer to itemize. So that's a big part of the reason why so few taxpayers are itemizing today. There's still a sales tax deduction, but basically the way that works is this is really a good option for those that are in a no income tax state, because you can claim the greater of your state and local income taxes or your state and local general sales tax. So while that's good on one front for those that maybe don't live in a state with an income tax, the issue comes is that it still is part of that $10,000 cap that I mentioned on the prior slide. So even if you have this ability, it's still going to be aggregated with those other taxes and capped at $10,000. But it's still good to know because maybe your situation, you have a lot of charitable contributions, your itemized deductions are much higher, and maybe this helps you get to the $10,000 number that's capped on state and local income tax and real estate taxes. Now we're going to talk a little bit about healthcare expenses. So the first thing is this chart is reflecting of monthly premiums for Medicare Part B and Medicare Part D. And so this is important. Number one is that you do have the ability to write off your Medicare premiums for itemized deduction purposes. But where this is also really important is that Medicare Part B and Medicare Part D is now, the premium is based off of your income. So when you're making planning decisions between now and year end, you want to make sure you're at least thinking about this aspect, because if you, I don't know, if you incur maybe some capital gains between now and year end, you might push yourself into a higher income level that actually drives up your Medicare premiums. So let's take a look at this in a little more detail. I'm not going to go through the entire chart, but I'll go through one example. So let's take a look at, for Medicare Part B in 2023, your base premium, if you're starting this year, is $164.90 per month. So if we go to, let's just pick a tier, and we'll pick this one, and we'll look at married filing joint. So I have single, and I have married filing joint, and we'll just focus on this particular range. So this is based off of what's called MAGI, for modified adjusted gross income, which is mostly going to be adjusted gross income for most taxpayers. So if your range falls in this level, you pay the base premium, and then you also pay an adjustment, almost double the base premium. Then you have Medicare Part D. So I put in kind of an average number of $40 per month for Medicare Part D. And then if you're in this income range, you're going to pay another $31.50 per month, for a grand total of $401.20 per month. So the income ranges are pretty high. As you can see, for the first one, as long as you're under $194,000, you're not going to have any adjustment to your Medicare premiums. But again, if you're doing other planning decisions and that changes your income levels, you want to at least be cognizant of this issue. And it might make sense to incur that decision to drive the income higher for whatever the reason might be. You just want to recognize you're going to have a higher premium to pay for Medicare. There's a 2-year lag with this. So for those paying Medicare premiums over the last handful of years, for 2023, it's based on your 2021 return. So the decisions you make today would impact your premium in the year 2025. So those with long-term care insurance, you do have the ability to write off long-term care insurance premiums, but there's a however in this. You can see that it's based on your age. So you take the taxpayer's age at the end of the year, and you can see they're basically in 10-year increments. You have 40 or less, then you have from 40 to 50, 50 to 60, 60 to 70, and more than 70. So over on the right side is how much of your premium you can write off. So you can see 40 or less, it's only $480 you're allowed to write off. And then as you get older, the amount increases. So you have that limitation. And then whatever this number ends up being for you gets put into your medical expenses. And as you might recall from the prior slide, you have to have higher than 7.5% of your adjusted gross income before you can even write off your medical expenses. And then those get added into your itemized deductions, which have to exceed the standard deduction to get any kind of a benefit. So there's a lot of hurdles you have to jump through, but it's still good to know, because your situation may be such that you're able to really get at least a good write-off for your medical expense. So just some things that are now qualified for medical expenses. Over-the-counter medical expenses are now qualified for that purpose when it relates to an HSA or a health savings account. If you still have an old Archer medical savings account or a flexible spending account. You used to be told about maybe 2 or 3 years ago, they had taken over-the-counter medical expenses away for that purpose. Now we're going to talk a little bit about retirement plans. So for those of you that are working, you participate, say, in a company 401k plan, you still have time, depending on how your payroll works, to maybe increase your contributions. So if you have what I'll call a traditional 401k, 403b, or 457b plan, and you are making contributions to it, those will be pre-tax write-offs. So that's a way to immediately reduce your taxable income and get money into your retirement account. And your employer might have a Roth option, and that's something that you can consider to use if that is being provided. The one thing you have to recognize with the Roth option is that the money goes in after tax. The big benefit of the Roth option is that if you follow the rules for it, the distributions down the road in retirement will be tax-free. Whereas money that goes in pre-tax, when you take the money out in retirement, will be taxable. So this gets into planning around your tax brackets now versus what you anticipate them being in retirement to help make that decision. But the contribution limit this year, $22,500 for everybody. The catch-up contribution for those age 50 and over is $7,500. IRA contributions, I always break them out as being three types: a deductible traditional IRA, a non-deductible traditional IRA, and a Roth IRA. A couple of similarities among the three. The deadline is April 18th, 2024. The contribution limit is $6,500 for everybody. And then the catch-up limit or contribution limit for those age 50 and above is $1,000. Now we'll take a little bit of a deeper dive into the different types of IRAs. So you are able to write off a traditional IRA contribution, but there's a couple of howevers that get thrown into this. If you're covered by an employer-sponsored retirement plan, so think of like a 401k plan, then you can only write off your IRA contribution if your modified adjusted gross income is within these following ranges. Now I broke this up between single and married filing joint. Let's just focus on single. You read this the same way, no matter what the filing status is. So if your modified AGI is up to 73,000, anything lower than that, you can write off your traditional IRA contribution. If it's between $73,000 and $1 and $83,000, you prorate it and it's a partial write-off. And then if it's above $83,000, you don't get to write off the traditional IRA contribution. So if you have a traditional IRA and you're not covered by an employer-sponsored retirement plan, there's no income limitations. No matter how much income you make, you can write off your traditional IRA contribution entirely. For a Roth IRA, there are income limits associated with that. And so we'll stay with the single filing status for this purpose. If your income, your modified adjusted gross income up to $138,000, you can make a full Roth IRA contribution. If you're within these income ranges, it's prorated or partial contribution. And if it's above $153,000, you are not eligible to make a Roth IRA contribution. And the income limits are higher if you're married filing joint. So one thing before I jump into this slide, talking about the IRA, so whether you're determining which type of IRA you're going to make. If the Roth IRA, it's pretty cut and dry in terms of those income levels, whether you can or can't. But as long as you have earned income, which you need to support any of these retirement plan contributions, you're going to at least always be able to make some type of an IRA contribution. So oftentimes we'll get the phone call that, I'm not allowed to make an IRA contribution this year. That's not going to be the case if you have the income to support it. What often gets misunderstood, I guess you could put it, is that what might happen is that your income might be too high. You participate in the 401k plan and you can't write off the contribution. So I'm going to go back to that one slide just to have the illustration up. And so when you're covered, let's say you're single, and let's say your modified adjusted gross income is $95,000. So you're above the $83,000, which means you do not get to write off the traditional IRA contribution. However, you can still make what's called a non-deductible IRA contribution. So you always have that option It's not like you lost the ability to make the IRA contribution. Now, you might want to consider the Roth. That might be a better option. But let's just stay with the traditional IRA example. You can still make the contribution if your income is above 83. You just don't get to write it off. And that's still really important to do for most people, to make that contribution if you can do it, because that money grows in a retirement account that's tax deferred. So you're not going to pay taxes on your interest and dividends along the way. And that's still a really major benefit in terms of compounding your earnings, or compounding your growth, if you will. So just if you have the earned income, you're going to be able, you can make some kind of an IRA contribution. I think if you just remember that part. There's a lot of details to go into it, of course, but just remember that always is going to be an option for you. So for an individual 401k plan, this is going to be for somebody that is self-employed. This is really attractive. You need to have it set up by the end of the calendar year. The contribution deadline is your tax return deadline plus extension, so basically October 15th. It's attractive because it provides a higher contribution level than a SEP IRA, which has been in existence forever. The individual 401k plan has been around for quite a while now. But because you are able to put more into the individual 401k, that can be more attractive. And it works just kind of like a 401k plan, but you're the only person you're the employer and the employee. So you're able to contribute dollar for dollar up to the contribution limits for 2023. That's the number for everybody. Here's the catch up. And then there's a second part of the calculation, which is what's called the profit sharing contribution. That's 20% of your net self-employment income. So that number will fluctuate based upon what your actual net income is. So that makes this plan very attractive. You can set up these plans, as long as you have it set up by the end of the calendar year, you're good to go. You're not committing to funding it. You don't have to fund it, but at least you have it up and running, and it's very attractive. For 2023, the maximum contribution overall is $62,000 for everybody, or $72,500 if age 50 and above. So that you have to have a really high amount of income in order to do that, but it gives you a lot more flexibility. This slide reflects the SEP IRA. So one thing that's good about the SEP is there's a little more flexibility. You can set this up before the tax return deadline. It doesn't have to be by the end of that calendar year. The big difference with the SEP and the individual 401k plan is that the contribution calculation is just this component, the 20% of net self-employment income. That was the second part of the individual 401k plan contribution. It doesn't have the quote-unquote employee portion where you can contribute dollar for dollar up to the contribution limit. So that's why the individual 401k will always give you more flexibility to put more money in. The contribution limit for the SEP IRA, and then there's no catch-up contribution for the SEP IRA. So it's just a couple of differences that can make a big difference depending on your situation. For those that have high income and consistently high income, you can become more aggressive with your retirement planning and set up a defined benefit pension plan. This gets more involved where you have to have an actuarial firm run testing to confirm the dollar amounts you can contribute, but it can be well worth it because your contribution amounts can be significant. It can even be close to 6 figures. Again, if you have to have the income to support it, of course, but it can be a very attractive option for you. And then again, I'm only referencing from a standpoint of where you're truly self-employed. You are the only employee of the firm. Your spouse can be part of that, and it doesn't add a layer of complexity. But as soon as you add other employees, really for any of these plans, it does add another layer of complexity. Okay, let's talk a little bit about health savings accounts. So these are really attractive accounts because you have what I call the triple tax benefit. And what that means is that the money you put into an HSA is a tax write-off. Once in the account, the earnings are tax deferred. And then if you withdraw the funds for medical expenses, it's tax-free. So it's one of the best vehicles out there for saving because you get the pre-tax deduction, the tax-deferred earnings, and tax-free withdrawal. A Roth IRA is really attractive because it has the tax-free withdrawal, provided you follow the rules for it, the tax-deferred earnings it has, but it's after-tax money going in, whereas the HSA is actually pre-tax going in. So a really nice benefit from that standpoint. You have to have what's called a high deductible health insurance plan in order to qualify for an HSA. So what exactly does that mean? So for 2023, these are some of the IRS limits pertaining to an HSA or health savings account. The maximum contribution limit for a single plan is $3,350. For a family plan, it's $7,750. There is a catch-up contribution available. In this case, it's $55 and above, and it's $1,000 for single, $1,000 for a family plan. So to qualify to be a high deductible health insurance plan, the plan has to have a minimum deductible, and that's $1,500 for single, $3,300 for family. Then there also has to be a maximum out-of-pocket cost pertaining to the plan. For a single plan, $7,500. Family plan, it's $15,000. Normally, with the health plan itself, it should say on it that it is a qualified plan or a high deductible plan for this purpose, so it's very clear. But if it's not, these are just some of the kind of the numbers you want to look for. Really, these two, the contribution limits, that's after. That applies for everybody if they have these two features as part of their plan. Those are the two key things you want to look for. So if you happen to have a health savings account and you take the money out for non-medical expenses, it's taxable, and you have a 20% penalty on those earnings before age 65. Then once you hit 65, the penalty goes away and you still pay the taxes. So that's not so bad. It's like a retirement account at that point. And then there is an age limit for contributions, which is 65 unless you delay Medicare. So if you're still working and your employer plan requires you to go Medicare Part A, you're not going to be able to make an HSA contribution anymore. If you're on your employer plan and it doesn't require you to go to Medicare A, then in that case, you could be older than 65 years old and still contributing to an HSA account. So for those with a flexible spending account, so the flexible spending account, these are the plans that are set up through your employer. It allows you to contribute into this account pre-tax through your payroll. And then the contribution limit is $3,050 for 2023. And then these are the accounts where it's a use it or lose it situation. The HSA, the nice thing I didn't mention from that before was that you can carry your balance and you can actually, you don't have to touch it. You can let that grow and maybe use it down the road for maybe long-term care, some type of expense like that, but you're not required to pull the money out. Where the flexible spending account, you do have to take the money out. So it'll depend how that exactly works. It'll depend on how your employer set up the plan. There's an option where it's use it or lose it by March 15th of the following year. Or there's an option where you can have a $500 carryover, but it's use it or lose it for the rest of that calendar year. So it just depends on how your employer has it set up, which one you have to follow by. All right, so we're going to talk about Social Security income taxation. So this calculation on the screen is really important. Probably have never heard the terminology used, but this is how Social Security handles it. So your provisional income is going to be determined by your adjusted gross income plus half of your Social Security income plus any tax-exempt municipal bond income you have. So what that means, and I'm going to go to the next slide, is that your provisional income determines how much Social Security is subject to income taxation. So the breakdown on this chart, we have married filing joint, we have single, and for this one, we'll focus on married filing joint. So if your provisional income is under $32,000, the amount of Social Security subject to tax is actually zero. If you're between 32 and 44,000, up to 50% of your benefit can be taxed. And then if you're over 44,000, which ends up being most people, up to 85% of your benefit is going to be taxed. So if you're on Social Security, but maybe haven't started your what's called required minimum distribution, which I'll talk about shortly, you could have a situation, depending on what kind of investment accounts you have, where your taxable income could be low, and perhaps you're in these ranges where you're not paying too much tax on your Social Security. So as you're doing, again, planning decisions, you're looking at capital gains, or maybe you have capital gains and you want to offset them with capital losses, so maybe your income falls maybe in these two ranges. So your Social Security isn't taxed as much, or maybe taxed at all. This kind of information, this all sort of gets synchronized with some of the other slides that I've covered. And when you're doing tax planning, you have to think about all of these things so that you're not, or maybe, if you have the ability to reduce your capital gains, to maybe push your provisional income down to a level where you're not going to pay, maybe you're at zero in that case, then it makes a lot of sense to try to really work through capital loss planning if you can, or tax loss harvesting, as I described it before. Now we will talk about required minimum distributions. And so we'll probably stop the slides in about maybe 5 minutes. I'm not going to cover every slide that's part of the presentation, but I left them in here. So if you want to have the slides for afterwards, you could see some of the other ones I put towards the end. They're oftentimes not the most popular parts of income tax planning, but I realize it's a lot of information. But this one's going to be really important as it relates to the required minimum distribution. You might hear this called RMD for the acronym, but this is the distributions that there's two different kinds we're going to cover. The first one is just simply based on your age. And so this has changed a lot over the last few years. It used to be at age 70 and a half, you had to start taking money out of your retirement accounts. And that's really what this is talking about. Now, for say this year, it's age 73. So the way this works is that it applies to your IRA accounts, and it does not apply to a Roth IRA account. So this will only apply to traditional IRA accounts. And so it also will apply to 401k, 403b, 457b accounts if you still have those, unless you own 5% or more of the company. Then you have to actually take each plan separately and do this calculation. Most of the time when you're retired, you end up just rolling your money out of a 401k plan to an IRA rollover account. And in those cases, you're able to aggregate all of your IRA accounts and do the calculation, and you can take the distribution from maybe just one account. But when you have the 401k plans and you have IRA accounts, you have to handle these separately. Same calculation, but you have to actually take the money out of these plans. So basically when you do that, that's going to be a taxable distribution. Now, if you've been able to put in after-tax money into your IRA accounts, for example, you will have basis, you'll have cost basis, if you will, with that should be reflected on your tax returns so you're not paying double taxes. But the mechanics on this is you're taking the prior year-end balance of, let's just say it's all IRA accounts, and you add them up, and then you divide it by a distribution period. So there's a table the IRS provides. It's called the Uniform Lifetime Table, and it's basically a life expectancy table, and you match up your age with the distribution period next to it. So in your first year, it's about a 4% withdrawal. And so you take the balance divided by the distribution period, and that's the amount you have to take out. Now, for those that have what's called a beneficiary IRA account, this area has gone through a lot of revamping of the rules over the last few years. So and I call this for really non-spouses. So for an IRA, if you inherited it from, say, your parents, what happens is that if the death occurred before 2020, you have to take a required minimum distribution. It's a little bit of a different calculation from the age 73 one that I just went through, but you have to take a distribution based on your life expectancy, and it uses this IRS single life expectancy table. Some of the mechanics are the same as the age 73 one, where you take the prior year end balance of that account and you divide it by that life expectancy factor. Then what's a little bit strange about it is once you get into the next year, you subtract 1 from that RMD factor, which is from here, and then you keep subtracting 1 each year thereafter. We help our clients with these calculations because it is a little bit confusing as far as how you go through that. But then you have to take the distribution each year. Then what happened is some rule changes came into effect. And so after January 1, 2020, and I'm still referencing non-spouses because if you are inheriting your spouse's IRA, you have more flexibility involved with it, because you basically can count that as your IRA and then I'll have to take the money out until you're age 73. There's some of the nuances that go in with that, but I just want to keep the focus on non-spouse IRAs because this is where a lot of the changes have come from. So the way it works now is that a non-spouse beneficiary has to take the entire value of the IRA out within 10 years. Used to be, you would just take a distribution each year for the rest of your life. So it's very advantageous from a standpoint of allowing that account to still grow tax deferred. So the way this works now is that for this calculation, to calculate that 10-year clock, the first year starts in the year following the death of the original owner. Now, it breaks into 2 other parts. If the original owner was taking that required distribution at the time of their death, then the non-spouse beneficiary must take a required distribution for years 1 through 9, and then in that 10th year, the rest has to come out. You can take more than that, but you actually still have to do a required minimum distribution. If the original account owner was not taking that RMD, the required minimum distribution at the time of death, then the non-spouse beneficiary does not have to take an annual required minimum distribution, but you still have to take the money out entirely by the end of the 10th year. So it's very confusing. Originally, when these rules were changed, the general thought process was that you just had to get the money out in 10 years in any way, shape, or form. And that's still true in letter B, but that is not true for letter A. So there's a lot of planning involved here, because even in this case in letter B, where you don't have to take money out each year, but you have to get it out in year 10, what you have to think about is that if you wait till that 10th year, you're going to let that account grow tax deferred each year, and then you got to take out a much bigger amount, hopefully, in that 10th year, and then that can be a big tax hit in that year. That still might be the best answer. However, depending on your situation, there could be a case made where it makes sense to maybe take some of that money out every year, or maybe some years, and not have such a big number in year 10 that maybe drives you up, I don't know, maybe 2 more tax brackets. So there's a calculation you can do, at least make some assumptions, and see if there's a really a good game plan to take. Because you might think just intuitively that it makes sense to wait until that 10th year, but that might not be the case. It just depends on so many other factors. But this is a really important area to at least take a look at and do some planning with. So it applies to, this whole concept applies to traditional and Roth IRAs. The nice thing about the Roth IRA is that it's not taxable. So same rules, really go through this, or the same process, if you will. But with Roth IRA, it almost always will make sense to let that money grow until the 10th year, because you take it out, it's tax-free. Now, your situation, again, may be such that maybe it makes sense to take some funds out of the Roth in those first 10 years. But generally speaking, you're probably going to want to leave the Roth IRA, a beneficiary Roth IRA, alone for that 10-year period. There are some exceptions to this. Minor children that inherit an IRA don't have to follow the 10-year rule. It does start once they reach age 18, though. If you're disabled or chronically ill, you don't have to follow this rule. And then individuals within 10 years of the age of the deceased don't have to follow all of these rules we just covered on this slide. It's confusing. There's a lot of planning involved, and we help our clients get through these decisions to make. This is a really nice benefit for those that have IRA accounts. It's called a qualified charitable distribution. And so what that means is that it's money that goes from an IRA directly to charity. So the best part about it is that if you're, say, at age 73 and you have to start taking money out of your IRA, you can actually have part of your distribution can go directly to charity. So let's say your required distribution is, let's just say it's $50,000. And let's say you make $10,000 of charitable contributions each year. Well, as opposed to taking the 50 or paying tax on the 50, you still got to get 50 out of the retirement account, but you can send 10 to the charity or charities. And then that counts towards the required distribution, but it's not taxable. So in my example, 50 was the required distribution number, 10 goes to charity, 40,000 gets taxed as opposed to the 50. That's a really big benefit there. They cap you at $100,000 a year to be able to do that for. You can't double dip. So if you do this, you can't use it as an itemized deduction. A little bit of a nuance is that this was set up whenever the beginning age for required minimum distributions was 70.5. While that has increased now to 73, you're still able to do a gift from your IRA, at age 70.5 up to basically age 73. So they never updated that part of the rule for whatever reason. You can use a beneficiary IRA, however, you have to be age 70.5. You can inherit an IRA at age 30, but you can't do the qualified charitable distribution until you hit age 70.5. So the last thing I'm going to cover is just around Roth IRA conversions. So with a Roth IRA conversion, this is where you're moving money from an IRA account to a Roth IRA. When you move the money from the IRA to the Roth, that's a taxable transaction. So you want to be careful about how much you may convert, if that makes sense to begin with, because you don't necessarily want to drive yourself up one tax bracket to the next bracket, or maybe two brackets, depending on what you're trying to accomplish. But it can be a really good move, because when you have to start taking the required minimum distribution at 73, let's say you retire, say at 65. So that's 8 years before you're forced to take money out of the IRA. And if you're not working anymore, and let's say you decided not to take Social Security right away, your tax bracket's going to probably be very low. So this is an opportunity to maybe convert some money, yes, pay the taxes, but get it over to the Roth IRA, because at age 73, when you have to start taking money out of your IRA, the Roth IRA is not subject to that. So there's no required minimum distribution at age 73 for the Roth. So that continues to grow basically forever. And then when you take those funds out down the road, it's tax-free. So this takes a lot of planning. You have to really work through some projections to try to get an idea of what your required minimum distribution will be at 73. Take a look at what tax brackets you're going to be in. Look at your tax bracket today, and then start running some numbers. Maybe it makes sense to convert some and maybe pay it at the 12% tax bracket, the conversion amount that is, as opposed to doing nothing. And then when you take your required minimum distribution down the road, maybe that puts you in the 22% or 24% bracket. So it's a way to control the tax brackets. The other part of this, taking this sort of a multi-generational approach, is that thinking about it, if you have, again, just say you have a non-spouse beneficiary, and say it's a child, they're going to inherit your IRA. And as I just went through those other rules, they're going to have to take money out within that 10-year period, depending on the circumstances on how they do it. But if it's an IRA, they're going to have to pay taxes at some point. If they inherit the Roth IRA, then they won't pay taxes. They can let it grow those 10 years. Yes, they got to get the funds out in 10 years, but it's a really great way to sort of do some multi-generational planning and help your heirs control the amount of taxes that they will basically pay at that point. So there's a lot of moving pieces. I'm going to stop the presentation of the slides to take any questions and answers, but these are a lot of the things we work through for our clients, is taking a look at their tax situation, seeing if there's, sometimes it's really obvious, you should make a decision or not make a decision that relates to, say, a Roth IRA. But you also want to coordinate these things with your Social Security timing. If you have taxable accounts, what kind of investments you have in those taxable accounts. We work with our clients to be strategic in where we place the investments. So sometimes placing bond investments doesn't make sense in a taxable account because you're going to pay taxes every year on that. So we work on a lot of things. It's called asset location. And there's a lot of moving pieces, as you can see with all of this. And then you're looking at the tax brackets, as I showed at the very beginning of the presentation. And there's a lot of juggling. So I'm going to pause for right now and see if there's any questions that have come through. So the other part of that is, while I was talking about one of the questions that came through surrounding tax planning, is when you're thinking about the Roth IRA conversion, that's one situation. But you might be in a situation where you want to look at taking withdrawals from your IRA just for living expenses, normal living expenses in that regard. And so, normally when you think about tax planning, you always want to defer the tax, let the asset grow, compound it for as long as possible. And a lot of times that makes the most sense. But as you get closer to the ages where you have to start taking money out, the required minimum distribution, there can be scenarios where it makes sense to withdraw funds from the IRA account to cover your living expenses, because it's a way. Now, yes, you're going to pay taxes when you take those funds out, but perhaps you're taking enough out that it controls or lowers the amount of the required minimum distribution at age 73. And kind of in the grand scheme of the rest of your retirement planning horizon, you can end up saving quite a bit of dollars as it relates to controlling the tax brackets. You've got to do a lot of planning, looking at projections, trying to gauge if it's really obvious that maybe it makes sense to take money out now and lower your tax burden over time. Those scenarios absolutely can work out. You've got to do some number crunching. Yes, the rules can change, tax rates can change. So, the best laid plan might have to change. You want to keep it as flexible and nimble as you can. But there are definitely situations where taking money out of the retirement accounts before required is actually advantageous to you, even if you have taxable account monies that you can live off of, where if you took money out of that account, you don't pay taxes on it. So there's a lot of those nuances you want to run through. And really the best way to do it is just running some projections. We were able to do year-to-year income tax planning for our clients, but coordinating that with retirement planning, looking over a 20, 30-year time frame perhaps. And sometimes it's really clear that it makes sense to maybe take funds out of the IRA sooner, or do the Roth IRA conversion if you don't need the money to live off of. I'll give another minute and see if there's any other questions that come through. And if you have questions specific to your situation, please don't hesitate to set up a call to go through what those may be. And we can at least talk that through. Okay, it looks like that's all the questions for now. But thank you very much, everybody. And I'm going to turn it back over to Dan.
Okay, great. Thanks, Jim. A lot of great information covered today, and I want to thank everybody for joining us for our webcast. If you would like to schedule a free conference call consultation with a member of our advisory team, please call our office at 412-635-9210 to set up an appointment. Thank you again for attending, and this concludes the event.